We have recording progress. We have Professor Lawrence White from George Mason University. Alfian here will give a better introduction than that. But on just a
Hopefully.
personal note for Bitcoiners that might be on the line, he's not only a person who's studied private currencies for many years and has been doing that, I think, since the 80s, correct me if I'm wrong later, along with Professor George Selgin, a friend of his. But they've been Professor White. He's interesting to Bitcoiners. He's been interacting with some of the early cypherpunks. He exchanged sort of had an exchange of articles back and forth in the mid '90s with Hal Finney, and has been cited by Nick Szabo as influential on his Nick Szabo and Hal Finney's thinking. So interesting points there. I'm interested to hear what we have to learn today. I enjoyed the book very much, Better Money, and I'll kick it over to. And thank you to BitcoinNews.com for the helping us promote this event today, as well as Huberto Leal, who has a podcast here in Brazil.
All right. So, ladies and gentlemen, everyone, it's my great pleasure to introduce you to Professor Lawrence White, whose new book, Better Money, we'll be talking about tonight. So, Professor White is a renowned economist from George Mason University, as you all know, and he's been a faculty member since 2009. He is widely known as an expert in monetary theory and policy. He's written a lot. He's a prolific writer. He's written a lot about the emergence of monetary and financial systems. And in his new book, he lays out the difference between fiat money, gold, and the emerging cryptocurrencies today. So I think just picking up where I'm left off, another interesting fact is that Professor White actually, I've read that he actually met Hayek at some point. So that's something, a point of interest for all of us, I guess. So yeah, I mean, I won't bore you or spill the details, spill the beans. All I'm going to say is that it's going to be a fruitful discussion, and I encourage you to pick Professor White's brains. It's going to be a fruitful discussion, and on behalf of the CME, we're a think tank based in Kuala Lumpur, Malaysia, but we've recently established a branch in Jakarta, Indonesia. We're a think tank that is passionate about promoting the ideas of free markets and how markets can deliver human flourishing and really uh, uh, promote the ideas of human liberty. So we're grateful for Professor White for being able to share his ideas and his new book with us today or tonight. So the floor is yours. Thank you.
Thank you, Alfian. I'm going to show some slides. So let me, host disabled participant screen sharing. Can you enable my screen sharing? Okay, here we go. Okay, so here's the cover of the book. In the background is Ben Franklin, who is the sort of archetype of the $100 bill, the most popular fiat money. But there's also a bar of gold, and there's a physical representation of a Bitcoin. So what I'm trying to do in the book is compare these as alternative monetary standards. So we all live with a fiat standard today. The world used to be on a gold standard. It could be on a gold standard again. The gold hasn't disappeared. The world could be moved to a Bitcoin standard. So what I want to talk about is which of these basic monies would best play the role of providing the kind of money that people want, which I believe is a money of stable purchasing power. So in case you're not familiar with the term fiat money, fiat means a decree. So it's a money based on a decree. And when we say fiat money, we mean it's not a commodity money. It's not redeemable for any tangible good. And it implies that it's imposed by the government. So I wouldn't call Bitcoin a fiat money because there's no compulsion, there's no decree. The difference between a commodity standard and a fiat standard is illustrated by an old and a new Federal Reserve note. Back when the Fed was on the gold standard, it said, "We'll pay the bearer on demand," meaning if you bring this $100 bill in, you get $100 in gold coins. When the Fed went off the gold standard, the contract, "We'll pay the bearer on demand," was just replaced by ribbon, $100. So it's just a decree or declaration. This is $100. It's not backed by anything. And why did the world make this move? Why are we no longer on a gold standard? And I think actually better than economics textbooks, the comic writer Dave Barry in his book on money actually got it pretty right. Governments discovered that gold is rare, meaning it was a constraint on their ability to print money. So they decided it would be more convenient to back money with something easier to come by, namely nothing. And that's the money system we have today. So it leaves governments free to print money when they find it convenient to finance their spending by doing so. And this happened, the big blow that ended the gold standard was the First World War. So governments went off the gold standard so that they could print money in hopes of financing the war with newly issued money. How have these fiat money regimes performed? Well, here's the longest time series I could find for Malaysia, and I was surprised how low inflation in Malaysia has been. There isn't any big spike during the pandemic. Still, it's above target, but actually not so bad compared to some others. Here's Europe. In Europe, inflation peaked at over 10% in 2022. It's slowly coming down. In the United States, it peaked at 9.1%. Again, it's slowly coming down, but this is a lapse of judgment by the European Central Bank and the Federal Reserve System to let the inflation rate get so high. They both have supposedly a target of 2% inflation. And so they've missed their target badly, and it's taking a while to get back to it. And why was there such high inflation? Well, you can't blame the pandemic alone. The pandemic was actually an occasion in which people hoarded money. So that should bring the inflation rate down. But the central banks injected lots and lots of money to offset that hoarding. And in principle, that's the right thing to do. But when the hoarding stops, when people start spending off their money, the central bank has to pull the extra money back out. And that they've been very slow to do. And that's why we've had such high inflation. If you want more experience than just the pandemic, there's probably the best study out there is by Rolnick and Weber, and they look at a panel of countries and compare their experience over many decades under commodity standards versus the same country's experience under fiat standards. And this is a chart that didn't appear in the published version of their article, but it's in the working paper version. And what you see is that the average inflation rate in this sample was about 1% for gold and silver standards, but 13% for fiat money standards. And that's leaving out the German hyperinflation. Every country in the sample had higher inflation under fiat money. So fiat money enables governments to print money with less constraint. And they've done so because there's a fiscal motive for doing so. So that's the danger with fiat money. And of course, Malaysia's experience hasn't always been low inflation. If you go back to the financial crisis, the exchange rate crisis in the late 1990s, there was pretty sharp inflation and a sharp devaluation of the ringgit. So how do we constrain central banks not to be so inflationary? There have been two approaches taken over the years. The first is to come up with some kind of rule, meaning some instruction set for the central bank, presumably with teeth, with some kind of penalty for not hitting the target. We have inflation targets today, as I mentioned, but there's no penalty to the central bank for failing to hit its target. So it's, as Bill Murray said in Ghostbusters, it's more of a guideline than a rule. It's not really a very tight constraint. An alternative way of approaching the problem is to think about why we get, and this is Hayek's approach in the Denationalization of Money, this first edition published in 1976, expanded edition in 1978. This small book was a big influence on my research. And Hayek says, let's step back and ask why we have such poor quality money. And he's writing at a time where inflation is in double digits in the United States and is over 20% in Great Britain, where this short book is published. Why do we have such low quality money? Well, what do we rely on for high quality automobiles and computers and clothing? We rely on competition among private firms. If we find shoddy merchandise, we switch to another supplier until we find one we can trust. So we need competition in order to ensure the quality of products, and the same applies to money. So Hayek's proposal was, let people in any country use the money of any other country. And that might provide more discipline on central banks if they see their clients going somewhere else. And the less demand there is for the local fiat money, the less revenue potential it has for the government. So there's their incentive. But Hayek goes a step further and says, we can imagine allowing private providers of currency to compete with government providers. And what would that look like? Well, he imagines that the private providers would promise to keep the value of their currency stable in terms of some index basket of goods. Well, that hasn't really happened, but the idea that we should open up competition, I think, is the really valuable part of his proposal, apart from his prediction of what would happen. He doesn't think people would go back on a gold standard, and he doesn't think that the value of the currency would be guaranteed by contract, simply by a promise that competition would enforce. Emil mentioned my interactions with some of the original, the Bitcoin original gangsters, or OGs. And following Hayek's denationalization of money, I was working on private money ideas when very few other people were. And much to my amazement and delight, my work has become more relevant with the introduction of Bitcoin. So my dissertation was entitled Free Banking in Britain. That was published in '84. I had a collection of essays in '89 entitled Competition and Currency, and then a textbook called The Theory of Monetary Institutions, where there are chapters on the gold standard and on private money, unbacked private money. And there I have some doubts about whether Hayek's system would really work if there weren't contractual guarantees, because it would be very tempting to just print more money by the private producer, as long as people are putting a positive value on it and the cost of adding zeros is negligible. So the private producer has a big profit grab possible. And so it won't work unless the value of staying in business exceeds the value of grabbing that one-time profit. And historically, the way private producers have attracted customers was by offering a money-back guarantee, by redemption for gold or silver. So in an essay entitled What Kind of Monetary Institutions Would a Free Market Deliver in 1989, I was trying to look forward and ask, if we adopted Hayek's proposal to let free competition reign, what would the outcome be? And my prediction was more likely that it would be traditional redeemable money on a gold standard or something similar. I did note that there was another way to guarantee that the money won't be hyperinflated. Instead of a money back guarantee, or you might call that a price guarantee, alternatively, you could have a quantity guarantee, a quantity commitment not to issue more than so many units of money. And this idea I got from Ronald Coase in one of his lesser known papers entitled Durability and Monopoly from 1972. And Coase says, well, imagine you're buying an art print and you're paying, these are my numbers. Suppose you're paying $500 for a lithograph. It doesn't cost them $500 to print an additional lithograph. So it looks like if you pay $500, you're vulnerable to the producer after they sell all the ones they can sell at $500, deciding to start selling them for $400. And so the value of what you just bought dropped. So how can they assure you that that won't happen? They number art prints. They make it a limited edition. This print is number 162 out of 300, let's say. So you know only 300 will be produced. Well, that is the solution that Bitcoin adopts. It guarantees, it commits itself to a certain quantity of Bitcoin, and we know the release schedule, and there will never be more than 21 million units. But I didn't think that would fly as a medium of exchange because it would leave the price volatile. The price would be determined day by day in the market rather than being anchored to something more predictable. So I was wrong about it being the unlikely to launch an asset, but I'm not quite wrong yet about it being an inappropriate way or an unlikely way to ground a money, a commonly accepted medium of exchange. We'll come back to that in a second. But as Emil mentioned, I had an exchange with Hal Finney. At that point, he was talking about privacy through digitally encrypted currency on the model of David Chaum. And there wasn't much, but a little bit of discussion about whether this would lead to a new monetary standard. And I was skeptical, and Finney was less skeptical. He thought there could be the banknotes issued under a private system could either be redeemable for gold or something else, or they could be internet native, their own unit of account. When Bitcoin comes along, Finney, of course, is the first person to tweet running Bitcoin. He was running the code. And he rightly describes Bitcoin as a token whose production rate is predictable and can't be influenced by corrupt parties or uncorrupt parties, by anybody. It's set in the source code. And he says this would be analogous to gold. So there is some inspiration in Finney's thinking and in Nick Szabo's thinking. Nick Szabo was an early cypherpunk who's proposes, although he never codes it up, proposes a model that he calls BitGold. And Finney and Szabo are, of course, leading candidates for having written the white paper pseudonymously attributed to Satoshi Nakamoto. So I had some interaction with Szabo on a email list, a private email list of his, although he doesn't seem to have kept the records of it. So I don't remember really what was said there. Anyway, the Hayekian proposal to think about competition among different monetary units or media of exchange is now more relevant than ever because there are new entrants into this competition, both internet native in the form of Bitcoin, currently worth a remarkable $519 billion. That was as of yesterday. There are other cryptocurrencies, so-called, but they're not really as likely to become currency, to be used as media of exchange as Bitcoin is. So I'm going to focus on Bitcoin. But the blockchain technology has also enabled very easy acquisition and transfer of gold-based claims in the form of ERC-20 tokens. So Tether Gold was the first, but Pax Gold is actually a bit larger today. Now, their size is 1,000th of that of Bitcoin, but they provide a potential competition as media of exchange. And they're also non-tokenized, but sort of online gold banking, gold transfer services like Glint and a number of others in the competition. So we need to think about there's new possibilities for the emergence of alternative monetary standards to compete with fiat standards. Let me first talk about the properties of a gold standard and then the properties of a the properties of a Bitcoin standard, so that we can talk about which one is more suitable to serve as a commonly accepted medium of exchange. In a gold standard, if there's I apologize to those of you who haven't taken introductory economics for drawing supply and demand curves, but we have an initial purchasing power of gold determined by the supply and demand for monetary gold. If there's an increase in demand, let's say the economy grows, so there's more demand for money, or if you want something dramatic, a new country joins the gold standard, that drives up the purchasing power of gold. But that's not the end of the story, because at a high value, at a high real price, it's more rewarding to mine gold. So gold miners will now dig more deeply. And over time, and that's the dashed line going southeast, the supply curve will start to shift to the right as gold accumulates. More gold is being mined. There's only so much industrial demand for it. So the rest is turning into coins and bullion. That's increasing the stock of monetary gold over time. And that increase will continue until the incentive to mine more goes away. And that doesn't happen until the purchasing power of gold returns to where it started. So a gold standard has a mean reverting character. In the face of demand shocks, it returns the purchasing power of gold back to where it started, assuming there's no change in the meantime in the cost of extracting gold. So when output is growing faster, if the world economy is growing faster, that will make the stock of money grow faster, and that will stabilize the purchasing power of gold, PPG. As evidence of that, here's data I gathered from a couple of sources, one on the stock of monetary gold and one on the growth rates of the Western economies who are on the gold standard. And in the period between 1807 and 1870, you have economic growth of about 2%, and you have growth in the gold stock of about 2%. Between 1870 and 1913, you have faster economic growth because of the Industrial Revolution. You also get faster gold growth, because if there hadn't been faster gold growth, the purchasing power of gold would have kept rising, and that would have incentivized more gold mining. And so it's not an accident. This is my point. It's not an accident that the gold standard had a very stable purchasing power over the entire 19th century, over the period from 1800 to the First World War. Many economists don't really understand the gold standard and yet pontificate about it, and they think it's just an accident that gold retained its purchasing power, but it's not an accident. It's built into the economics of gold mining. Bitcoin, of course, doesn't have any commodity value. It does have its own payment rails, and that's the real use case for Bitcoin. That's a valuable service. You can make payments to people around the world without the payments going through the banking system, or more importantly, through central banks, because central banks are choke points. If you try to send US dollars to a dissident group in Belarus, let's say, it will not get there because the Belarus government will not let the recipients have a bank account, and they will stop the payment from going through. But you can send them Bitcoin. And Alex Gladstein has a useful book called Check Your Financial Privilege, where he talks about the many cases in which transfers can be made by Bitcoin that would be censored or are censored by central banks. As I mentioned, Bitcoin's supply mechanism is a fixed release schedule, like a numbered art print. So that assures people that it won't be hyper expanded. And it's guaranteed, as they say, by a combination of cryptography and game theory. So in principle, the source code could be amended by Bitcoin miners, but it's not in their incentive to do that. So it seems to be pretty durable. Bug fixes, yes, you can get a consensus for that. But for changing the release code, no, you will never get a consensus on that. Nobody wants to kill the goose that lays the golden Bitcoins. But in the work of Finney and Szabo, this model is to some extent inspired by gold-based free banking. So quantity of Bitcoin, here's the path. I was corrected a couple of weeks ago when I said that it's absolutely predetermined. There's actually a little bit of fuzziness around the path, because if additional miners join, there's actually a slight increase in the amount of Bitcoin won. The blocks are won a little bit faster than is scheduled. And it takes a while before there's an increase in the difficulty of solving the problem that rewards the miners with new Bitcoin. But within a percent or two, we know how many Bitcoin we have today. We know how fast it's growing until the next reduction in the growth rate, so-called halvening. And we know it will hit zero by about 2140. So if we contrast Bitcoin and a gold standard using supply and demand curves, the supply of Bitcoin is absolutely vertical. It doesn't respond at all to its purchasing power. Whereas even in the short run, you get some response in the quantity of monetary gold in response to an increase in demand, because people will melt down their jewelry when it becomes more valuable as coins. And recycling gold is actually something like 30 to 33% of new flows of gold for industrial use. So there's a little bit of supply increase, quantity increase, and that means the price increase doesn't have to be as much. So even in the short run, you get less volatility of price under a gold standard. But in the long run, the difference is really dramatic, because in the long run, as I showed earlier, the purchasing power of gold returns to its long run flat trend, whereas, so the supply curve is flat, whereas Bitcoin still has a vertical supply curve in the long run. And that means all the action is in price. Variations in demand are only felt in price and not in quantity. Historically, the quantity of monetary gold grew slowly under the gold standard, but that rate varied. When the price was high, when the real price was high, there would be more gold mining, and so that would bring the real price back down. The purchasing power of gold would be stabilized. Whereas there's no such response in Bitcoin. And so it's not unfair to say that purchasing power volatility is built into the design, into the vertical supply curve. Here's some evidence of Bitcoin's volatility being above that of gold or foreign exchange in terms of the dollar. And this is over a long sample. And a lot of Bitcoiners want to believe that the volatility is going to come down, but there's no reason for it to come down. Right? The supply curve is still vertical and demand is still volatile. Now, if it were adopted as a medium of exchange, yes, the volatility would come down, but it's hard to get there from here. Very few people are going to adopt it as a medium of exchange while the purchasing power is so volatile. You don't want to keep your rent money in Bitcoin, right? Because it may drop 7% tomorrow when your rent is due. Here's daily price changes. And again, Bitcoin is the red spikes, and the pound, euro, yen, and gold are in the band in the middle, so much less volatile. And this result was foreseen, or this problem was foreseen by several people, including Vitalik Buterin, who said, look, it's going to continue to be volatile And so that makes it unsuitable as a stable unit of account or as a stable valued medium of exchange. So what can we do about that? We can experiment with flexible monetary policies. That is, with a cryptocurrency whose quantity responds to demand. I'll come back to that in a second. So we have these new competitors. Are they going to outcompete fiat money? Well, first, they're at legal disadvantages. Tax rules, restrictions on ownership in many countries, disclosure requirements that discourage people. But even if we did away with that, the established fiat standards have a network advantage. People want to be paid in the thing that they can turn around and spend most easily. So there's a great deal of momentum in a monetary standard. Now, it's not absolute. We have seen people spontaneously drop the peso when it was too inflationary and adopt the dollar. So you get dollarization from the bottom up. And the reason they choose the dollar is that it has a lower inflation rate and it's less volatile. So that's what an alternative needs to be adopted spontaneously. So I don't expect small differences, small inflation rates to lead to spontaneous adoption of either a gold standard or a Bitcoin standard. It will take pretty serious inflation and no prospect of returning to low inflation in the dollar and the euro and other fiat monies to move spontaneously to alternative standards. But if the fiat standards do break down, and it's good to have a plan B, which would it be? I think gold is actually more likely than a Bitcoin standard. It's got a bigger installed base of users. Most importantly, its purchasing power is less volatile. Bitcoin does have the advantage of being harder for governments to seize, at least for people who keep their coins off of the exchanges, who keep them in their own wallets. But governments can drive it underground, right, by making it illegal to advertise that you accept Bitcoin or to use Bitcoin. And that makes it hard to become a commonly accepted medium of exchange. But there's one more possibility, and this has emerged recently under the label of flat coins. So a flat coin is like a stable coin, but one that's indexed, right? So stable coins like Tether and USDC are only as stable as the dollar that they are pegged to. But flat coins adjust for changes in the dollar price level. So they have a stable purchasing power, not a stable dollar value. They're still very early on. Two examples are Spot and Nuon. They're not even listed on the most popular exchanges now, so they're actually hard to come by. An alternative to that is, so that's a pegging arrangement, but with a peg adjusted as the price level adjusts. An alternative to that, and disclaimer, I'm an advisor to a project called Saga Coin, which is trying to implement this, would be a crypto coin where the program has a Oracle feed to the purchasing power of the coin, and the supply responds to changes in purchasing power like the classical gold standard did. So it's a demand elastic supply. So that's where we are, and I will happily take questions in case I've said anything interesting or controversial. Thank you.
All right. So if anybody has any questions, feel free to digitally raise your hand, or and I'll see if I can figure out how to call on you. And while we're waiting for that, someone sent me a question to my phone. I'll read it off. The person says,
wait, Emil, wait.
Sure,
First,
yeah.
we have the second part of the presentation, which is the discussion from Professor Gemberg from Asia School of Business that partner with the Center for Market Education for this event. Professor Gemberg is the director, is an economist and the director of the program in central banking from the Asia School of Business, which is a prestigious campus set up by the Malaysian Central Bank in cooperation with MIT. So we are indeed honored as a CME to have ASB as partner for this event, and we can pass the floor to Professor Gamberg for his discussion.
Thank you, Carmelo, and thank you, Professor White, for a very excellent presentation. I actually, when I was first asked to join this webinar, of course, first thing to do is to go out and buy your book, and which I did on Kindle, and I'll be reading it, and it's a fantastic book. The history of monies is in the first 2 chapters is really fascinating, and it's of course then translates into questions of today, whether gold and or Bitcoin will become a money of the future. If I may share my screen, I have a few comments to make about that, and they to some extent go along with the conclusions that Professor White has drawn, but I want to make a few other comments, which is so. Can you see my screen?
Yes.
Yes.
Called Better Money.
Yes.
Yes.
All right, good. So this. Let me just perhaps mention 2 things about myself. Apart from being a professor of economics at the Asia School of Business, my graduate education in economics was at the University of Chicago, and one of the professors that I took a course from, he wasn't my thesis advisor, but it was Milton Friedman, and so the notion of sort of good money is something that was brought to my attention early on, and of course he had his rule for a stable path of fiat money, much as the suggestion for a stable path for flat coins or other types of private monies. But let me make remarks on, apart from some general remarks, some remarks about stability of inflation under different standards, and also, most importantly, in my view, what it implies, different standards imply for the international monetary system. Now, as I already said, the presentation in the book, and of course also in this webinar, is masterful by somebody who has worked on private monies and money in general for a long time. And as I said, my comments is going to be about the recent inflation experience if we had had a gold standard and or a Bitcoin standard, and then I'll talk about implications for the international monetary system. Here is the inflation that we've seen already in the graph in the presentation by Professor White. Inflation in the United States under current US Fiat standard. It's been relatively stable around 2-3% with some ups and downs. And of course, the most lately, which has generated a lot of angst, is the high increase in inflation around 2000 in the past few years. Now, if we compare that to a gold, what would have happened to the inflation rate if the price of gold in terms of dollars would have had the same evolution that it has actually had, and it had been it had a gold standard. Now, this is not to say that if it had a gold standard, the price of gold would have behaved in the same way. But nevertheless, you can see that the volatility of gold prices in terms of dollars, and therefore the volatility of gold prices in terms of goods, is an order of magnitude larger than that of fiat currency. In the period from here, 1990 onwards. It was not necessarily true in the past, as Professor White showed. that fiat monies were more stable, but at least the US dollar has been relatively stable in the past 30 odd years. Now, if you look at what would have happened if it had Bitcoin if you measure inflation in terms of Bitcoins, then it's again in order, both the gold standard and a fiat standard look pretty stable in comparison. And that's the usual comment that people make, that Bitcoins are way too volatile for them to become useful as a medium of exchange and as a money or store of value for that matter, or unit of account. So that, therefore, my question on that is that is there any reason to believe that if gold or Bitcoin or any other cryptocurrency would become a monetary standard in a country, would the price of that unit be less volatile than it has been in recent years? I don't have the answer to that, but I don't see any particular reason why one should believe that it becomes less volatile. And because it's still going to be an asset that people can hold, and that asset depends on the price depends on expectations of agents who hold that asset in the international markets, and international asset markets being what they are, they seem to have generated lots of volatility, both in gold prices, not so much relative to Bitcoin. Because the prices of these assets aren't they aren't linked to a commitment of a central bank under an inflation targeting framework to keep the price level relatively stable. So my suspicion is that that the price of goods in terms of gold or Bitcoins will be relatively volatile under standards of that type. Now, Professor White showed us in terms of supply and demand analysis that in a gold standard system, there are opportunities, there are mechanisms which bring gold price levels in line with maybe relatively stable over time. I say relatively because the relative prices of gold relative to goods will change for all sorts of reasons, but it won't. They won't be enormous changes, presumably because of mining activities. But as he also showed in the slide, it takes years and years and years. So you could have bouts of inflation or deflation in terms of gold, and it would take, I think there was a mention of 20 years before you get back to sort of the stable long run price of gold relative to goods. And of course, those are, that's a long period of time, and one might question on sort of political economy grounds whether that will be acceptable in an economy. So my basic comment on that is that I think in current circumstances, fiat standards in most countries, not all, I grant that, most countries have been relatively stable, have generated relatively stable inflation rates compared to sort of possible crypto standards or gold standards. Now, let me move to a second topic which I want to emphasize, and that is the consequences for the international monetary system under different standards. In the fiat standard, that we have today, in any case, we have the possibility of having different monetary conditions in different jurisdictions because the central banks are issuing the money in the different monies in different jurisdictions, and therefore they can change the quantity that is produced or the interest rate that is associated with the reserves in that currency according to business cycle conditions in the country. Now that if I go back to my days in the course of Milton Friedman, he wouldn't necessarily agree that central banks should do that. They should let the money supply grow at a constant rate or effectively. However, in inflation targeting frameworks, there is a sort of a commitment, not with contract, I agree, that central banks should keep the inflation rate within certain limits and therefore generate a stable inflation while at the same time adjusting the interest rate or the monetary instrument in such a way that they also look after some notion of employment or growth in the economy. Now, under a gold standard, monetary conditions will be the same across jurisdictions. There's no possibility for countries to adjust their monetary policy under if there is a drought, lack of in agricultural production, or if for other reasons there's a change in employment or inflation in the country. It will be the gold standard is set in the world market. Gold price is set in the world market, and therefore it will not be able. There is no possibility to adjust monetary conditions according to the particularity of the economy of a particular jurisdictions. And I believe the same is true for a Bitcoin standard, as long as there's one standard across all jurisdictions. So of course, there could be the possibility of having several having different Bitcoin standards in different jurisdictions, in which case we would have flexible exchange rates between the coins and between national monies. Now, my suspicion is, and sort of based on price variability during the past 20 years where these things have existed or less, is that these exchange rates would be highly volatile, even more volatile than exchange rates are at the moment. So I think it's from a sort of a, if you call it political economy standpoint, I would be very, very surprised if countries, governments in different jurisdictions would allow monetary or would essentially adopt a global monetary policy for their country and give up the flexibility of having their own currency, their own fiat currency. So my conclusion is basically that based on recent price behavior, both a gold standard and a Bitcoin standard would be would lead to quite variable inflation rates, and that are order of magnitude more volatile than fiat monetary standards under the Federal Reserve, not under Mr. Maduro of Venezuela, perhaps, but under many countries' fiat currency systems. The second conclusion or summary is that the gold standard or the Bitcoin standard implies an international monetary system with effectively fixed exchange rates. And that, again, I think will be something that is not necessarily desirable. And I don't think it will be accepted by the authorities in different jurisdictions. And let me end my comments there in the interest of time and in the interest of allowing other people to pose questions. But again, fantastic presentation and a very interesting book by Professor White. So that's the end of my talk, my comments.
Thank you, Professor Gamberg. I'd ask first to Professor White if he wants to add any quick remark on this discussion before we open the floor to the attendees.
Yeah, very quickly. It's true that the price of gold has been volatile since we demonetized gold in 1971. But if you want to study the behavior of a gold standard, you need to look at the past, not at the present, because gold is not a monetary standard right now. It is an inflation hedge. So there is speculative demand that drives its price up and down. But when it's the monetary standard, nobody speculates in gold because it's the money they use. It's true that there were bouts of inflation and deflation under the classical gold standard when we look at that historical record, but we have to keep the magnitude in mind. The most inflationary episode under the classical gold standard followed the discovery of gold in California and in Australia a couple of years later. But by modern standards, it was trivial. The California discovery meant that the supply of gold rose at about 6.5% a year for a decade, rather than the average of 3%. And that meant inflation was about 1.5% for a dozen or so years. And so by 1.5% inflation is, pretty mild by modern standards. And deflationary episodes likewise, because the main cause of deflation under the gold standard was, following the logic of the equation of exchange, when the output of goods was growing faster than the supply of money. Right? That would give you more goods chasing each unit of money and lower prices, dollar prices or money prices of goods. But that's entirely benign. It's driven by rapid growth in output. And so it's mild and it's benign when there were episodes of deflation. Deflation was not associated with depressions statistically under the classical gold standard. I agree that a gold standard means that monetary conditions are roughly the same across jurisdictions because gold will flow to equilibrate conditions. If the purchasing power of gold is higher in one place than another, gold will flow to that place and equalize. That's the price specie flow mechanism. It does mean that there's no domestic monetary policy, but we have to ask ourselves, is that a gain or a loss or a gain? Mostly domestic counter-cyclical monetary policies have been a failure. They haven't diminished the volatility of real output. They haven't dampened business cycles. In a study with George Selgin and Bill Lestraps that we published in the Journal of Macroeconomics a decade ago, we found that even in the United States, the volatility of the business cycle has not fallen since 1971 as compared to the classical gold standard period. And we have much fewer financial crises. We still have financial crises, by the way, but in the United States, they were a chronic problem in the late 19th century. But even so, recessions were no worse under the classical gold standard than they are today in terms of the volatility of real output. And lastly, I agree that countries are not going to be eager to surrender their monetary sovereignty. But of course, national governments are not eager to adopt all kinds of free market reforms that we would urge on them. So it takes education and sometimes it takes a crisis. So some countries only switched to floating exchange rates when they had an exchange rate crisis. But as far as giving up a domestic currency, well, all the countries in the Eurozone have done that. They voluntarily surrendered their national monetary sovereignty and adopted a transnational currency. Countries that have dollarized have done a similar thing, although they don't have a vote on the monetary policy that they import from the Federal Reserve System. It's better than the monetary policy they had before. And so after an inflation crisis, as in Ecuador, after the public has already dollarized itself, it's a natural thing for the government to concede to the public's demand for a more stable currency. Another interesting case is El Salvador, where there was no crisis. They were in fact pegged to the dollar, but the market didn't believe their peg. So they said, well, to make it really credible, we will just outright dollarize. So there's no longer any local currency that we can devalue. And so there we take away the devaluation risk, and now we can borrow in world markets at lower interest rates. So the adoption of other currencies will come either from the bottom up when domestic currencies are unstable, or from governments that realize that they're not doing a good job producing money and they should adopt something more stable. That's it.
I want to go ahead without Carmelo's go ahead to me.
Please go ahead. Thank you.
Okay. Cheers. Thank you. All right. Okay. So we've got 4 different questions. Let's see. The first one I have is to Professor White, of course. The process for creating new Bitcoins is completely insensitive to changes in demand for Bitcoins. Given this, we expect the price to be more volatile than it would be otherwise. To this day, Bitcoin's volatility remains many times greater than the volatility of gold. Does your observation explain most of Bitcoin's volatility, or are there other factors that contribute substantially? He says, I don't see how a 1 to 2% annual increase in supply could tame the volatility of an asset that often changes in value more than 50% year by year.
Yeah, so I agree with all of that. Is there something else driving the volatility? Well, we have to explain why the demand is volatile. And people have studied this. Finance people have started studying what's driving the price of Bitcoin. And it's not always hedging against inflation or tail risk. It's also in part driven by news about Bitcoin. So when the Chinese government, when it becomes rumors start or an announcement is made that the Chinese government is cracking down on Bitcoin, that's bad news. That drives the price down. Other pieces of news create greater optimism. So some analysts say that Bitcoin has no fundamentals, but I think there is a fundamental, namely the probability that Bitcoin will become the world's money. And that's how it's being, that was the original vision that Satoshi had for it. And when that probability changes, then the price of Bitcoin changes. So news that changes the probability of Bitcoin's widespread adoption as a medium of exchange will change the price. But of course, people are trying to anticipate the news, and so the price moves ahead of the news. And so it's not always clear what's driving it on any particular day.
Okay, fair enough. The next question is, since more gold deposits can be found, not limited, or fake gold circulates, isn't Bitcoin the best money for humanity with a fixed hard supply of 21 million?
Well, so my argument is that an elastic supply is better than a fixed supply because it helps stabilize the purchasing power, which is a desirable quantity. A desirable quality. It's something people want. in their money. Now, if you want to speculate and if you want to get rich, then you don't want a stable valued asset. You want one that rises in value. And people who got in early have done very well investing in Bitcoin. The last 2 years, they haven't done so well. It's true that there is a problem of fake gold, and so vigilance is necessary. And so there are costs associated with verifying gold, but the very same problems apply to Bitcoin. There are Bitcoin scams, and so vigilance is necessary in order to be sure that you're getting Bitcoin and not a phony claim to Bitcoin. I don't need to mention all the scandals. Of course, that's not the problem of the Bitcoin source code. That's the problem of people issuing what they say are claims to Bitcoin or warehouse receipts for Bitcoin when they're not. So diligence is necessary with both kinds of money.
Okay, thank you. Next one, if authorities don't like Bitcoin or gold, as they have tried to ban in the past, does it really matter as it's decentralized? Oops, Zoom moved it. I didn't get to finish. It says, don't the people decide what's the best money to save and trade in?
Well, that's the world I like to live in, where the monetary standards are determined from the bottom up and not from the top down. Yeah, so I guess that's the answer.
For those that don't know Professor White's work, my understanding is you want competition in money. If there's one phrase I think that I get from your work is you want competition in money.
I have a book entitled Competition in Currency.
Yes. So there you go. Next question: If a global reserve fiat hyperinflates every 100 years, why should the people trust the USD anymore? It eventually will fail too, based on history.
Well, back in around the turn of the previous century, early in the 20th century, the well-known economist Irving Fisher, who in many ways was a forerunner of Milton Friedman and a theorist of the determination of the purchasing power of money under a fiat standard, himself said that paper money has proven a curse everywhere it's been adopted. And up until that time, we had, in fact, not ever seen a stable paper standard. It had always been hyperinflated. John Law's famous scheme, fiat monies during the First World War, you got very high inflation, price levels doubling in a few years. So the jury was still out. Now, we've had more positive experience since 1971 in the sense that not every fiat currency has had chronic 20% or higher inflation. Some have been relatively stable, relative to others, but still all have been unstable relative to the classical gold standard. So chronic, the average inflation rate for the dollar has been about 4% since 1971. It's lower now, which is a good thing. But as the question asks or suggests, there's no guarantee that it will stay low. And where we see countries experience hyperinflation, it's because the government has to print money to pay its bills. And so it's a fiscally driven crisis. And the US is not in good fiscal shape. So I don't know if it'll happen in my lifetime or in the questioner's lifetime, but yeah, there's no guarantee that fiat money will continue to only inflate and in single digits. So personally, you want to hedge against that by holding non-fiat denominated assets or by holding inflation indexed assets.
Okay. And one from me, I think I know your answer based on your approach to money is, would you be delighted if Bitcoin did become a global standard?
Well,
From the bottom up, from the bottom up.
Yeah.
Not encouraged from the top.
Sure,
Yeah.
because it's a money where we don't have to worry about the quantity expanding too rapidly. That's predetermined. For that to happen, there would have to be widespread adoption as a medium of exchange so that demand becomes much less volatile. And that brings the volatility of Bitcoin down to the point where more and more people were willing to adopt it as a medium of exchange. So that's conceivable. And if it were to happen, that would be a great thing, because it would mean that the volatility problem had somehow been solved. Now, one thing that might help enhance the demand for Bitcoin as a medium of exchange and make the demand therefore more stable would be the development of banking on a Bitcoin standard. And that's been very slow to develop, actually, because nobody wants to take out a loan denominated in Bitcoin. I shouldn't say nobody, but there's a very limited demand for exposing yourself to that kind of risk. Yeah, exactly.
Yep. And I think we have to go back to the definition of money: commonly used medium of exchange, not commonly used store of value. So
store of value just means asset. So real estate is a store of value. Stocks and bonds are stores of value. It's nothing particular to money. So the defining characteristic of money, as you say, is a commonly accepted medium of exchange. And ancillary to that, or a spinoff from that, is use as a unit of account. People will denominate prices and keep their books in the unit they actually want to be paid in, because that makes sense economically and imposes less information burden on customers than putting prices in something you don't actually want to be paid in. That would just be a hassle for everyone.
Okay. And Professor Hans Genberg, I see an electronic hand up. Would you like to ask a question?
Yes, please. Thank you. My view of sort of hyperinflations or high inflation is typically that they come from a fiscal problem. Sure. And the government's the central bank then financing the fiscal problem, and they get unstable money. Now, if in a system where we've moved to a gold standard, and perhaps the government has, I would say, temporarily said, okay, you can pay your taxes in gold coins or whatever the gold certificates that exist out there. If there's a fiscal problem, they might say, sorry, no longer possible to pay in gold. You have to pay in whatever money we issue, or therefore they're going to. What guarantee can we have that fiscally irresponsible governments will abide to the constraints on the gold standard if they don't abide to a constraint of a stable fiat currency? So that's sort of my problem from a point of view of government accepting different monies than whatever they happen to issue themselves.
That's a perennial problem. How do we, who guards the guardians? Who keeps the government from abusing its power, whether military power or police power or money printing power? And the classical answer is that the price of liberty is eternal vigilance. So the public has to keep itself informed, and it has to, make it politically impossible for governments to be fiscally irresponsible. That's going to take a lot of education and that's why we need think tanks to tell people what to look out for. And we need a lot of monetary education so the public doesn't have the wool pulled over their eyes by governments that want to blame inflation on everything but their own actions, but their own money printing and their own money printing to pay the government's unpaid bills.
Okay, we have another question here. Might another open source cryptocurrency protocol offer fundamentals for a medium of exchange if the open algorithm actually hid the randomly set the randomly set number of units to be created over time. That isn't clear, let me know.
I don't understand the question, sorry.
We'll move on to another one. If Bitcoin is adopted as a medium of exchange, will it destabilize the economy by experiencing monetary disequilibrium, excess demand over supply, thereby causing a recession or a depression, even without the boom phase of the Austrian business cycle theory?
So, as I understand the question, if the quantity of Bitcoin is growing very slowly or not at all, if we're at the end where it doesn't grow at all, and the economy is growing, is that sustainable? Because it will generate falling prices. It's okay up to a point, as I said about the classical gold standard. If the reason prices are falling is that output is growing more rapidly than the quantity of money, that's not a problem. That's benign. But Bitcoin does, and under the classical gold standard, there was never a period in which deflation was anticipated at a rate so much as to drive the nominal interest rate to the zero lower bound. That is, interest rates were always positive, and so the interest rates were flexible enough to clear the market for intertemporal exchange. There is a danger with Bitcoin that we would be at the zero lower bound, and if there were some shock that made it necessary to lower interest rates to clear the market, that couldn't happen. And so the result would be, as the question suggests, an unsatisfied excess demand for money, which would put, unless the price level falls immediately, means that there's an excess supply of goods and services, an excess demand for money. And so there's a recession on the route to reestablishing monetary equilibrium. So that does concern me. I have a few paragraphs about that concern in the book.
Okay. Another question: why is converting cash or fiat to Bitcoin considered speculation?
Well, if you convert it in order to immediately spend the Bitcoin or transfer it to someone else, that's not speculation. But if you're buying and holding, if you're hodling, you're hoping for a price rise, that's speculation. I don't mean it in a negative sense. We all speculate in our investment portfolios.
Fair enough.
Take the last question, Emil. Then we go toward the closing.
Fair enough. Last one here. Someone says, who cares how stable the purchasing power is if fiat is not backed by anything? The person says, I'd rather live in a hard or sound money like Bitcoin.
Well, it's true that when the price of Bitcoin drops 10% in a day, it's not because the supply changed. In that sense, it's a hard money. But it happens nonetheless because the demand changed. And if you're holding it, intending to pay your bills with your Bitcoin, you now have a problem because the value of your holdings just fell. So it's true, you haven't been cheated by the issuers of money, but nonetheless, you wish you had held your money in a form that hadn't lost its value so much. So I'm not trying to impose my aesthetic opinion on how the behavior of the purchasing power of money should look like. But what I observe is that people will voluntarily move from a volatile money like a high inflation peso into a relatively less inflationary, more stable currency like the US dollar until last year. And so I mean, I might be wrong about that. If enough people feel the way the questioner does and they don't care about high volatility, then they may hold Bitcoin as a medium of exchange and I guess they just have to have bigger buffer stocks to make sure they don't run out of
Mhm.
money to pay their bills.
I think that's fair. That's it for my part. Thank you very much.
Thank you, Emil. Just allow me a few brief concluding remarks. First of all, thanking Professor White for having accepted to speak at our event. We have restarted our series of webinars after a pause. We were very active in 2020 and 2021 with webinars because there were few alternatives at that time to do something interesting and meaningful, and probably people had more free time also to attend these kind of events. We have started indeed the first webinar with a professor precisely from ASB, Professor Renato Lima de Oliveira, who spoke about oil economics at that time. And then over the years, we have hosted Roger Koppel, Peter Bottke, Robert Barro from Harvard, Darren McCloskey, and Karen Vogn. We have discussed a few times monetary economics. I must confess that I have personal interest in the topic. My PhD long time ago was indeed in monetary and banking history. So I'm reading the book with great interest. And probably one good thing that the Great Lockdown did was precisely to recreate the debate on inflation. So we didn't have a debate about inflation and the origin of inflation for many years. So over the past couple of years, the theoretical debate on inflation is back to the fore. This is interesting. We have quite alternative approaches to it, like MMT. We have discussed MMT a couple of years ago in a webinar as well, and etc. So these are my thoughts on the specific topic. Again, thanks again to Professor White. Allow me to thank ASB, here represented by Professor Gemberg, for having accepted to partner with us. We have done a few things together now, and for us is a big honor because we are a young and a little bit I would say voluntary and therefore cranky organization under certain perspectives, but highly motivated in our enthusiasm to try to bring something meaningful into the discussion. And I really care for us to be not only present in the policy conversation in Malaysia as we are, and you know that, but really also to have this kind of events that try to raise the level of the conversation to to a higher theoretical level, and therefore thanks again to Professor Gemberg and ASB for the partnership. Thanks to Alfian for the promotion through our newly formed branch in Indonesia, and thanks to Emil for having accepted immediately the idea of helping organizing and moderating this event. Emil is a very active commentator and writer on topics of alternative currencies, so I invite you also to follow his writings on the net. We have one more event before the summer break, let's say, so we'll be on the 6th of July. For those who are interested, we have invited Professor Edmund Phelps, Nobel laureate in economics 2006, to talk about his latest book, a sort of intellectual autobiography, My Journeys in Economic Theory. So we will go into the summer break with another very interesting event. Thanks also to the participant. Obviously, we do this for them, not only for having a conversation between all of us. I hope they enjoyed the conversation, and I hope that they will continue to support the Center for Market Education initiatives in the future. So thank you again. Thank you very much, and have a good evening, night for those in this part of the world, and a good day for those on the other side of the world. Thank you very much.
Thank you.